The trading floor is still quiet. The screens are already awake. Currencies move before people do. You arrive at 6:18 a.m., not because anyone told you to, because everyone else who wants to survive is already here. You are 22 years old. You graduated 8 weeks ago. Your base salary is $115,000. Your student loans still total $81,600. The paycheck looks impressive. The debt reminds you that it isn't. You don't touch money, not yet. You touch information. Hundreds of pages every day. Annual reports, debt schedules, earnings transcripts, merger presentations. You stop reading like a student. You start reading like someone looking for risk. That is the difference. The first month teaches you something nobody mentions during recruiting. The smartest analyst rarely becomes the most valuable analyst. The dependable one does. At 11:43 p.m., your associate sends another message. Need the model updated before 7. No explanation, no apology. You rebuild a 5-tab valuation model while the city sleeps. By sunrise, the numbers are waiting in his inbox. Nobody thanks you. Nobody needs to. Your reward is another assignment. That is your first lesson. In finance, reliability compounds faster than brilliance. One afternoon, while checking debt covenants, you notice something unusual. A revolving credit facility has been linked to the wrong interest assumption. Just 25 basis points, almost invisible, across a $760 million financing package. It changes projected interest expense by nearly $1.9 million over 3 years. You verify it twice, then a third time. You don't announce it. You quietly correct the schedule. Your associate notices during the review. He doesn't compliment you. He simply replaces your name on the next live deal with someone else's. Not as punishment, as recognition. In this business, more work means more trust. Weeks become months. You stop measuring time in days. You measure it in transactions. 3 sell-side mandates, 1 refinancing, 2 fairness opinions, 1 acquisition worth $540 million. You never sit across from the CEO. You never negotiate price. But every number they discuss passed through your keyboard first. That changes how you think. Money isn't just cash anymore. It becomes structure, risk, probability, control. 18 months later, your title changes. Analysts now send their work to you. You stop asking whether a spreadsheet is correct. You ask whether the conclusion is. A client wants to acquire a healthcare company for $1.4 billion. The valuation looks aggressive. Revenue is growing. Cash flow isn't. The private equity buyer believes operational improvements will double margins within 4 years. Maybe they will. Maybe they won't. Your job isn't to predict the future. Your job is to show every version of it. You build the downside case. Revenue slows by 8%. Interest rates rise another 75 basis points. Exit multiple contracts from 12 times to 9.5 times. Returns fall below the fund's target. The room goes quiet, not because you killed the deal, because you proved you understood the risk. That earns something more valuable than praise: credibility. The second rule: people with capital don't pay for certainty. They pay for someone who understands uncertainty better than everyone else. Soon you attend your first management presentation. The CEO speaks confidently. The investors nod. You already know which assumptions are optimistic. You built half of them. For the first time, you realize every deal tells 2 stories: the one presented in the boardroom and the one hidden inside the model. Only a handful of people ever read the second one. Now, you're one of them. 3 years pass. Another promotion. The spreadsheet is no longer your identity. Decision-making is. Your calendar replaces your model. Calls begin before markets open. Founders, private equity partners, pension funds, law firms. A manufacturing company needs $980 million to expand into Southeast Asia. The financing works, on paper, then commodity prices fall. The downside scenario suddenly becomes realistic. The client asks a simple question: would you still do this deal? Everyone in the room looks at you, not because you're the oldest, because your answer will shape what happens next. You pause, not for drama, for discipline. You explain the risks, the refinancing options, the liquidity buffer. The board votes to proceed. Months later, the expansion succeeds. People remember the outcome, not the uncertainty. They rarely do. By now, your annual compensation is approaching $600,000. The money changes your lifestyle. It doesn't change the game. You begin to understand something larger. Financial power isn't created by having the biggest balance sheet. It's created by becoming the person trusted to make decisions when billions of dollars are uncertain. And that realization changes your ambition forever. The calls start before sunrise now. Not because the markets are open, because someone somewhere is about to make a decision involving more money than most companies earn in a year. And they want your opinion first. You no longer build the model, you build the people who build the model. 3 vice presidents, 8 associates, 15 analysts. Their mistakes become your mistakes. Their success becomes someone else's headline. That is leadership inside finance, invisible. A founder walks into the conference room. He built a manufacturing company over 32 years. 8,000 employees, factories across 4 countries. His family still owns 78% of the business. Today, he wants to sell it. Not because he's losing, because he's 70, and none of his children want to run it. The expected valuation, $3.6 billion. The negotiation lasts 4 months. Every sentence matters. Every email is reviewed by lawyers. Every decimal point is questioned. The buyer wants a lower price. The seller wants certainty. Neither side actually gets what they want. They compromise. That's what transactions really are. The 4th rule. The larger the deal, the less it depends on numbers, and the more it depends on trust. You notice something else. The best clients never ask who has the highest IQ. They ask, who has closed deals like this before? Experience becomes a currency of its own. A private equity fund calls. They are raising a new fund. Target size, $12 billion. Half the capital is already committed before the first presentation. Not because of the pitch deck, because investors already trust the people presenting it. Reputation compounds exactly like capital. Slowly, then all at once. One evening, your team presents an acquisition model. Everything looks perfect. Revenue growth, operating margins, cash flow. Every assumption is defensible. Then you ask one question. What happens if energy prices stay elevated for 5 years instead of 2? The room goes quiet. Nobody built that scenario. Within 30 minutes, the projected return falls from 21% to 13%. The deal still happens, but the financing structure changes completely. One question protected hundreds of millions of dollars. This is what your job has become. You don't provide answers, you identify questions everyone else forgot to ask. Clients stop calling the bank. They call you. When they say, we need your team, they really mean, we need you. That distinction is worth millions, because relationships survive long after transactions disappear. You stop chasing business. Business starts finding you. Private equity firms, sovereign wealth funds, family businesses, government agencies. Not because they need information, because they need confidence. A renewable energy platform is looking for growth capital. Required investment, $8.4 billion. The project spans 3 continents, 9 regulatory approvals, 4 different currencies, 32 lenders. None of that is the hardest part. The hardest part is convincing every participant that everyone else will stay committed. Money follows confidence. Confidence follows leadership. And leadership is now your product. Your calendar becomes impossible. Breakfast in Dubai, board meeting in London, dinner in Singapore, video conference somewhere above the Arctic while your plane crosses time zones. You forget what day it is, but you always know which market is opening next. Compensation crosses $5 million, then $8 million. You stop looking at annual income because your investments earn more than your salary. Your wealth starts working longer hours than you do. A client loses nearly $900 million during a market correction. They don't fire you. Instead, they ask one question. What do we do next? That's when you understand something important. Clients don't pay you to avoid uncertainty. They pay you to remain calm inside it. The 5th rule. Capital respects consistency more than brilliance. One transaction changes your perspective forever. A logistics company employs 36,000 people. An acquisition could increase shareholder value by almost $2 billion. It could also eliminate 6,000 jobs over the next 3 years. The board discusses efficiency, synergies, operating leverage. Nobody uses the word layoffs. They don't need to. Every person in the room understands what those numbers represent. The vote passes, the acquisition closes, the stock rises 11%. Investors celebrate. Thousands of families prepare for uncertainty. Finance rarely creates simple heroes or simple villains. It creates incentives, and incentives shape decisions. The higher you climb, the less emotional the conversations become. Not because people stop caring, because every decision affects too many people to ever satisfy everyone. Power feels different than you imagined. It isn't loud, it isn't dramatic. Most of the time, it's a quiet room, a closed door, and one sentence that changes billions of dollars. Titles become unnecessary. The introductions become shorter. Everyone already knows who everyone is. You no longer manage transactions, you allocate capital. That single difference changes everything. Your family office oversees nearly $28 billion. Not all of it belongs to your family. Some belongs to entrepreneurs, some to institutions, some to families who stopped thinking in generations and started thinking in centuries. The portfolio is unlike anything you imagined as an analyst. Ports, data centers, insurance companies, private credit, satellite infrastructure, water utilities, artificial intelligence. The question is no longer, will this investment double? The question becomes, will this still matter 25 years from now? A financial crisis begins to form, not on television, not on social media, inside balance sheets, inside refinancing schedules, inside debt maturities that very few people are paying attention to. You notice it almost 18 months before headlines do. Companies that borrowed at 2% now face refinancing near 7%. Cash flow doesn't change. Interest expense does. That difference quietly destroys businesses. You don't panic, you reposition, less leverage, more liquidity, long-term infrastructure, defensive cash flow. When the slowdown finally arrives, your portfolio declines, but far less than everyone expected. People call it brilliant timing. It wasn't timing, it was preparation. The sixth rule, real financial power isn't predicting the future. It's surviving futures that everyone else ignored. Governments request private meetings. Central bankers attend conferences where you're speaking. CEOs ask how you're viewing the next decade. Nobody expects certainty. They expect perspective. And perspective is impossible to buy. It has to be earned. One afternoon, a young analyst presents an investment memo. He's nervous. He reminds you of someone. He speaks too quickly. He apologizes for details nobody noticed. His projections aren't perfect. His thinking is. The meeting ends. Everyone leaves. You ask him to stay. You hand him a marked-up copy of his presentation. Only one sentence is highlighted. Always understand where the money comes from before you decide where it should go. He nods. He thinks that's the lesson. It isn't. The lesson is what happens next. He'll spend the next 30 years discovering that money is never just money. It's influence, responsibility, trust, fear, patience, and above all, time. Because in the end, the people with the greatest financial power aren't the ones who earn the most. They're the ones who understand that capital is simply a tool. The real asset has always been judgment.